Hello, welcome to the Saving with Steve show, where we talk about the ins and outs of money, pretty much everything under the sun that relates to you having a happier, healthier relationship with money. My name is Steve Sexton. This is the Saving with Steve show, and I want to welcome you to the show. In fact, I want to thank you for joining us. We have over 600,000 listeners. Hey, we just added another 45,000 listeners coming from the UK that stream it all over the world. So we're very excited about that. We've only been with them for a couple of weeks or a couple of months. I'm sorry. Now, we have a wonderful show for you. Now, in the second half of the show, one of the big items here is this $3.5 trillion spending plan. Everybody's trying to figure out how the government's going to pay for it. Taxes, the whole shot. In fact, right now, Congress and the Senate and the White House are arguing over what's going to happen or if it's going to be $3.5 trillion. Once it passes and, when it goes into effect, it's going to affect us all. We have Danny Artech, financial advisor, author, mentor, entertainer, to help us understand what's going on. I'm going to be talking about, hey, you know what? The market's been going up, 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 and up. How do you diversify to reduce the risk and make sure you still have the income retirement? Also, so you don't have to be in a position if the market goes down where you have to go back to work. Now, next, whoa, this is a biggie. You know what? Many seniors are wondering if they have enough money to last for the retirement. In fact, that's the biggest worry. But they're leery about going into retirement communities now more than ever because of COVID. Some seniors can't even get long-term care because of COVID. Many of the seniors don't realize that their home equity likely represents a large portion of their net worth. In fact, if you're over 62, you've probably see the value of your home increase. Understanding how to strategically and tax efficiently incorporate that wealth into your retirement plan, your retirement income plan, can be a key to protecting your long-term, your nest egg, the ability to live your life and have the income you need so you don't have to disrupt it. You know what? The cool thing about it is we've got Steve Sless here. He's known as the go-to person when it comes to housing wealth source. He actually was the 2021 reverse mortgage game changer by Yahoo, and it's been educating people through videos, media, and all other things. So we're lucky to have him. Steve, thank you for joining us today.
Likewise. Thank you for having me, Steve. Great to be with you.
Well, you know what? I just want to say this. Once we let people know that you were coming on the show, our viewer line, or I want to say a line or email, just started blowing up. And you know what? But before we jump into this, I know you were in regular mortgages for a few years and you've been into reverse mortgages for about 15. Tell us your little story. Why did you transition into the reverse mortgage world?
Yeah, I got into the mortgage business, about 20 years ago now, and spent the first few years of my mortgage career doing what most mortgage professionals do, and that's cash out refinances, purchases. At that point, there was a big subprime market, and we were originating those loans as well. And I had to make a big decision, 2007, 2008, when the housing bubble came crashing down. What was I going to do? Right at that point, the company that I worked for was not able to originate FHA loans, and that left me really unable to perform the business that I've come to know and love. And I had to make a very strategic decision at that point. And I had started researching reverse mortgages at the time, but I was in my young 20s and I had a lot of doubts that I would be able to engage with an older demographic. But through my research and through my studying, Steve, what I found was the reverse mortgage is such an incredible tool to protect and prolong one's retirement. And I jumped in head first. And, 15 years later, I haven't looked back. In retrospect, it's the best career decision that I've ever made. I've dedicated myself to reverse mortgages and helping folks to live a better and more comfortable retirement ever since. And very grateful for making that decision a while back.
Well, you know what? I think it's a noble service you provide. The key here is what I really like when looking at your videos is you educate people. A lot of people are concerned because they've been doing the same thing for decades, and a reverse mortgage is something new. And I think one of the things is, if you can, I have a lot of questions, but I would love for you just to briefly talk about how does a reverse mortgage work?
Yeah, Steve, what we teach more than anything else is the concept of integrating housing wealth into a comprehensive financial plan, right? Steve, for 74% of folks that are 62 years old, they're already short of their retirement income needs. However, a new report came out about a couple months ago. There is over $9 trillion in untapped equity of folks 62 and older in America. Over $9 trillion. And so that money is dead equity. It's not working for those folks. It's not doing it. It's just sitting there dormant. What we teach, Steve, is how to incorporate that equity strategically and tax efficiently with a reverse mortgage loan, and use those funds, which is in most cases the client's largest asset. Use them proactively instead of reactively. And the result is we're able to extend their finances. We're able to extend the longevity of their investment portfolios. We're able to allow them to enjoy a better and more comfortable retirement. And we're able to make their money last longer because we're leveraging what is their largest asset, and that's the equity in their home.
Perfect. But okay, so when it comes to a reverse mortgage, everybody's trying to figure out, hey, will it work for me? Am I a good candidate for this? So help us, expand on that so people can say, hey, well, am I fit? Does it work? What? I know you just have to be 62, but other than that, how's it a good fit?
There's two different types of reverse mortgage. There's a HECM, a home equity conversion mortgage. Those are government insured reverse mortgage loans. And I would say probably 95% of every reverse mortgage originated today is a HECM government insured product. There's also now, Steve, been a lot of innovation on the proprietary reverse mortgage side. So private lenders, non-government insured, are now rolling out reverse mortgage products. And most of these loans are jumbo reverse mortgages. They are for a higher net worth clientele. We can lend on a jumbo reverse mortgage up to $3 million in cash for homes valued all the way up to $10 million. Reverse mortgages work like this. You got to be at least 60 plus. You got to own your home, and you got to have roughly 50% equity. And so for folks that have a mortgage, one of the biggest benefits is we can replace their traditional mortgage with a reverse mortgage and eliminate the mandatory mortgage payment requirement. And so by doing that, we're able to extend their cash flow. We're able to free up cash flow, free up finances. And we can also, if they have enough equity to qualify, we can release funds to them from the equity in the home. And that can be done in a variety of ways. Folks can choose to take a 10-year payout, which is basically your home sends you a check every month until the funds are exhausted. There's also a term payout where you just say, hey, Steve, I need X amount of dollars and I need it for X amount of period of time, 5 years, 10 years, 15, so on and so forth. You can take a lump sum from your home equity, or the most effective strategy is you can take out a reverse mortgage line of credit. And a reverse mortgage line of credit is very different than a traditional line of credit, Steve. One, they're federally insured. They can never be suspended, reduced, or frozen, irregardless of what the economy does or what the market does.
That's big.
These lines of credit also have a guaranteed growth rate attached to them. And so you're able to borrow more of your home equity every year the line of credit is in place.
Okay, I got a question on that. Let me ask you this question here. So when you talk about, because this is one of the questions my viewer asks, is, they know that your line of credit will grow by a certain interest rate each year. Is it based off the equity that you have that is available to be withdrawn, and that partial grows, providing you haven't take money out from that? Or
the line of credit has a set growth rate. And what's important to point out too is this is a growth rate. It's not interest. So think of it as a credit card where your limit is being increased each year.
Okay,
the
good.
growth rate on the line of credit is 0.5% over the interest rate on the loan. So today's interest rates on reverse mortgages are about 2.5–3%. Figure the growth rate is going to be 3 to 3.5% on any unused portion of the line of credit. Okay. So as you draw funds out, obviously you don't get any growth on the funds that you're pooling, but any funds that you leave and let sit in the line of credit, we call it a standby line of credit, because you can just park it, put it in reserve, put it on standby. Those funds grow over time, and you just treat it no different than any traditional line of credit, and you draw from it if and when you need it.
That's wonderful. Okay, so I think one of the big things there is that it can't be taken away. It can't be reduced. So that means if once the foreclosures and all that stuff comes to bear and the market values go down, even though somebody got a reverse mortgage today, say their equity line is 200,000 and maybe their house is only worth 200,000, they can't take that away. It's not like a credit card where they can reduce your credit limit.
Exactly. And think back, Steve, to 08, 09, when the housing market crashed. You had a lot of these folks were over 60. They had traditional home equity lines of credit. They thought they had access to $100,000, $200,000 or more in some cases. And the bank came back and said, you know what? Yeah, we're not going to let you borrow that money anymore. And that wrecked a lot of people's retirement plan. That cannot happen with reverse mortgages because the line of credit is federally insured. It is guaranteed. You're also, Steve, able to borrow on today's market value. We're in a booming housing economy right now. I mean, there's bidding wars on homes. You know, in some cases, homes don't even make the market and there's a bidding war already. And so values are soaring. You can take out a reverse mortgage line of credit today and lock in today's value. You and I were talking about this before the show came on. It's in all likelihood, values are going to at least level off, if not go down. So too is the market, the economy. And so it's a great hedge against future market corrections, being able to lock that line of credit in and do it at today's value, not future values, and know that that value is guaranteed.
Steve, that's wonderful. Hey, look, you know what? This is great information. We're going to take a quick break. Guys, stick with us. We got to pay some bills. We'll be right back with more Steve Sless. Perfect. That's excellent, Steve.
Thanks, Steve.
Okay.
Great questions. I mean,
well, you know, they're both yours and everybody's emailed in. I've got so many here. I can't wait to turn people over to you so they can start sending them to you.
I appreciate it.
Hey, Cameron, we're going to move into segment 2 with Steve Sless. So here we go. We're going to go ahead and get started. Hey, welcome back to the Saving with Steve show. Hey, I want to truly thank you for tuning in and appreciate you letting your friends, family, and associates know about the show. All the replays are available here at savingwithsteve.us. If you're enjoying the stories of helpful information, insight on Saving with Steve, then I encourage you to subscribe to our YouTube channel, Apple Play, and Spotify channel. Hey, check out a few of our affiliates at UK Health Radio, BBS Radio, Talk Radio New York City, E360 TV, Las Vegas TV Network. All these networks are dedicated to empowering you to live a life of financial and personal freedom. Also, you can follow us at Facebook at Saving with Steve Sexton if you'd like to some more financial tips. So here we come back with Steve Sless. We've got a slew of questions here, so we're just going to get started. You know what? There's pros and cons to anything. So let's just hit you. Hey, what's the downside of a reverse mortgage? What's the con side?
You know, I think it really starts in the beginning. It's all about suitability. And so when somebody comes to us, Steve, and they say, hey, I'm interested in learning about a reverse mortgage, there's first an educational journey that we need to take them on. We're also trying to figure out ourselves, are they suitable, right? So if you come to us and say, well, the first question we ask, Steve, is how long do you want to live in the home for? If somebody were to say 3 years, 4 years, it's probably not a great fit. And so there would be a downside there. I think the barrier to entry, the cost to take out a reverse mortgage loan is probably too great at that point if you're only going to be in the house for a few years. This is a long-term solution to living a comfortable retirement and doing so aging in place in the comfort of your own home. Look, another downside is, and it's not necessarily a downside, it really depends on what your viewpoint of this is. Reverse mortgages are loans that have negative amortization, which means that if you make no payments, and Steve, you can treat a reverse mortgage no different than a traditional mortgage. If you want to make payments, you certainly have the right to be able to do so. But a lot of folks choose not to make monthly mortgage payments. And if you choose not to make a monthly mortgage payment, your balance each month is going to increase. A lot of folks are fearful of that. They're fearful of their balance increasing. What we teach, Steve, is, look, the home is a low growth potential asset. Right? If you have a financial advisor that is managing your money and that money is well diversified, it's in the right markets, it's invested well, chances are that advisor is yielding you, 6 to 10% returns right now. Historically, the home appreciates at 1 to 4% per year. And so we teach, use the home equity first instead of using the retirement assets first, and combine all of your assets. But a lot of folks are a little hesitant because they're fearful of their balance rising over time. And look, at that point, you have to become educated, you got to become empowered, and ultimately you got to make the best and most astute financial decision for you.
No, that's great. Now, let's clear up some of the myths and misinformation. Okay. And I actually already know because I have experience with some of these, but our listeners don't.
Sure.
Now, can somebody lose their house with a reverse mortgage?
You cannot lose your house because you have a reverse mortgage. That's a huge misconception. And if we have time, Steve, a quick backstory. So prior to 2015, if you were over 62, you had equity in your home and you had a pulse, you had blood pumping through your body, you could get a reverse mortgage. There was no credit qualifications. There was no income qualifications. And so the result was you had a lot of folks that were already destitute. They had already run out of money and they were using the reverse mortgage as a last resort. The reverse mortgage just prolonged the inevitable. It prolonged their ability to remain in the home, but it was inevitable. They were going to lose their home because they just couldn't afford it. They didn't have enough income to pay the taxes and the insurance. Those are the qualifications of the reverse mortgage. You got to pay your homeowner's insurance, you got to pay your property taxes, and you got to maintain the home. If you default on any of those requirements, you will lose your home. But that's no different. Look, if you have a regular mortgage or even no mortgage at all, Steve, and you don't pay your taxes, you're going to get foreclosed on, you're going to lose your home. But by having a reverse mortgage, you cannot lose your home simply by having the loan.
Okay, perfect. Now, here's another question. And I also know the answer to this because I've experienced it before way back in 2008. What happens if, like, for example, we've got the market screaming up right now with the housing market, everybody wants to buy and all the supply line issues. Hey, I get a reverse mortgage. It's a $600,000 reverse mortgage. And you know what? The market goes down next week or whatever in a year. And my house is actually worth $300,000 and I pass away. What's going to happen? What are the options my heirs have?
That's a great question. So all reverse mortgages are non-recourse loans. Non-recourse means there's no recourse and there's no debt passed to your heirs or your estate that they have to come out of pocket and pay. So at the time of your death, your heirs are going to have the option to buy the house for 95% of the appraised value at the time. They can also walk away. If there's more owed on the reverse mortgage than what the home is worth, they can walk away and the non-recourse component kicks in. The HECM reverse mortgages have government reverse mortgage insurance on them. That insurance policy that is on all these reverse mortgages will settle the debt. It's almost like gap insurance for your car, Steve. Right? You total your car, you owe $20,000. The insurance company cuts you a check for $15,000. That $5,000 gap is covered. Reverse mortgages work the same way. So you can have the peace of mind of knowing that you can take a reverse mortgage out. And if at some point there is a market correction and you do owe more than what the value of the home is at the time of death, your heirs can simply walk away, or they have the option to buy it back at 95% of the value.
Yeah, one of the reasons why I asked that is I wanted to share the story for everybody. Back in 2008, one of my clients who had a reverse mortgage passed away, and the reverse mortgage was actually like $450,000. And after 2008, the house value, when they appraised it, was $195,000. When the heirs were looking at just dumping it, saying, "Hey, fine," but when I explained to them, I said, "You can get a house for $195,000 and let it grow." And they went, "Oh my!" And basically, they bought the house for $195,000 and sold it a few years later for twice that much. So they were, in a wonderful position when that occurred, and it's a great option. Now, one of the questions I do have is this. In this world, you have divorces, okay? And this question has come up, I probably have 30 of these questions. Divorce rates in California are at 50%. If it's a second divorce and they're older than 55, it's at 72%. What's the effect of a reverse mortgage and somebody receiving income if there's I'm going to say a gray hair or silver hair divorce?
I love that question, Steve. So we have a partnership. My firm has a partnership with the IDFA, the Institute for Divorce Financial Analysts. We're working with financial analysts that specialize in senior divorce, and we're helping them use reverse mortgage loans to navigate their clients, financial woes while they're going through these divorces. And so we're using the reverse mortgage as a tool to divide the marital home and use that equity for one person to remain in the home while the other leaves the home. We're also using it, Steve. We just had a case like this not too long ago where the couple sold their home for $300,000. They both put down $150,000 on two separate $300,000 homes. And they bought those homes with a reverse mortgage. You can actually use a reverse mortgage loan, Steve, to purchase a home in retirement. Most folks don't even realize that. Most realtors don't realize that. So it's a very effective strategy, and it's one that we are deploying quite a bit as we work through the Institute for Divorce Financial Analysts to help their clients, ease the financial difficulties of gray or silver divorce.
You know what? I just want to add this. Over the years, there's a number of clients that have come to me, and they've come to me because they're trying to find a way to make retirement work, and they've overspent or overhelped a child or something like that. And we've gotten in contact with a reverse mortgage specialist for the primary reason. In one case, the couple actually took out a jumbo reverse mortgage, but they were able to eliminate their current mortgage payment, which is a little over $2,500, which was the gap they needed to make their retirement work for the rest of their life. And then they had an equity line left over that they were going to use in case some health issues ramped up on them. And they were just going to let that grow until it was there. And you know what? That was probably 12 years ago, and they let that thing grow. I think it's like, like a little over $500,000, and they started tapping into it because of home care needs. So they're going to have more than enough to do it. And they're so thankful that, I said, hey, go look at considering getting a reverse mortgage because this is what you need. So they were able to prolong their life, have the retirement that they want, and now being able to take care of somebody just because they looked at what you talked about strategically, tapping into that asset, which is their, house equity.
Yeah. And look, Steve, there's multiple ways. Look, the bottom line is there's over $9 trillion of senior housing wealth that is not being used right now. Reverse mortgage is just one way to use it. There's other options. There's traditional mortgages. There's traditional home equity lines of credit. However, the difference with the reverse mortgage is there's no mandatory payment obligation. So if you're in your 60s or you're in your 70s and you're looking to take funds from the equity in your home, would you rather do it and not have to pay those funds back, not have a mandatory mortgage payment, or would you rather be saddled with a 15, 20, or 30-year mortgage payment and have to come out of pocket with that payment every month and until you're in your 90s in some cases? And so oftentimes it makes more sense to take out a reverse mortgage. But again, it's all about education, and it's about weighing the options, and what works for some may not work for others. And that's where we come in to help them figure that out.
Yeah. And one last thing before, one of the things that I have found as of recent, a lot of people are in situations like in states like California, Illinois, New York, where the cost of living's got pretty expensive. And their only options are to sell and downsize or move out of state, and sometimes moving out of state, or they look at getting that reverse mortgage just to free up that money that they need to make their life work. So, you know what? I think what you do is noble. I think what you're doing right now with educating everybody is very, very important and is needed. And that said, you know what? We're about to wrap up our segment with you. Could you tell us how people can get a hold of you, how they can go get your videos so they can get educated and, get the help they're looking for?
Absolutely. I appreciate the opportunity. So my firm's name is the Stephen J. Sless Group. It's the Stephen J. Sless Group. We are the reverse mortgage division for primary residential mortgage. We have branches in all 50 states throughout the country. You can reach us by phone. Our number is 410-814-7575. It's 410-814-7575, or online at the Sless Group, the Sless, SLESS group.com. On YouTube is where all our videos are as well. And we have a lot of educational content on there. If you just go on YouTube and search the Stephen J. Sless Group, You'll pull up our content. If you get there, I'd appreciate if you like the videos. And if you want to be notified when we put out more content, just subscribe and hit the bell at the top. And every time we release a new video, you'll get to know.
Hey, folks, the first thing of learning anything new is getting education. They've got a great resource at theslessgroup.com. So you want to go out there and look at it. If you're looking to get a hold of Steve, definitely go to that website. Steve, I want to thank you for joining us. Hey, stay safe, stay healthy. And you know what? We have a lot more questions to get answered. So we're probably going to have to circle back in a few months and have you back on. Is that okay?
I'd love to. I appreciate the opportunity. You're doing great work, Steve. I appreciate it.
Appreciate it, Steve. I've heard too many Steves today, and it's a great name you have. So, hey, we'll look forward to seeing you next time. Thank you so much for sticking with us today.
Thank you.
All right.
Bye-bye.
Hey, everybody, that was Steve Sless. You want to stick with us? We're going to be right back. Hey, welcome back to the show. That was Steve Sless. He was talking to us about how to use our home equity to make sure we can have the life that we want in retirement. So, you know what? If you'd like to get more information on Steve Sless, or go to theslessgroup.com. They're a wonderful operation, a lot of education. First step with any financial decision is getting education. Okay. Without education, you can't ask good questions, which means you can't make prudent, informed decisions. So life's all about making prudent, informed decisions. And this is all about the ins and outs of money. And that's one way to do it. So go to that website if you'd like more money. Now, this segment, I'm going to be talking about what's been going on. And I wanted to start this with a story about somebody I worked with way back in April 2007 and have continued to work with him. And he allowed me to share his story. See, this gentleman and his wife were referred to me back in April of 2007. Yeah, it was a long time ago. But in April 2007, he and his wife came in. And you know what you don't know about him is he worked in the startup and IPO industry. He wasn't, a money guy that did IPOs, but he helped build companies. And he was, in the midst of his third IPO that was going to get launched. The first two, kind of faltered after it got launched. One was just before, 9/11, in which case, the whole world for the tech industry went down. Since then, he had saved a bunch of money, and now he was looking to get this, multi $10 million payout, providing he stuck with the company for 6 months after the IPO. Now, the IPO was going to issue in November of 2007. When he came into my office, I asked him about his industry, and he spent 20 minutes talking to me about how fickle the IPO startup industry was and how very few actually make it. A lot like all these people want to be stars and musicians. Not everybody makes it. So when we were talking, he also had accumulated a little over $2.5 million. And you know what? I said, hey, look, if we're going to do retirement planning and tax planning, let's do them separately, because you told me how finicky the IPO world, and what if something happens and you know what, that IPO goes down? And he actually agreed with that. So we started talking about his $2.5 million. And I said to him, I said, you know what happens if we do have that downturn, your IPO goes away and the market goes down by 30 or 40%. Would you be able to stay retired, or would you have to go back to work? And he said, well, I'd probably lose $1 million and I would have to go back to work. And I said, is that something you want to do? And he said, no. I said, okay, what we need to do is we need to create a plan where we can reduce and eliminate the risk you have, and then make sure that you're getting the rate of return you need to live the retirement dream that you have. And he said, okay. And that okay look was one of those things like your dad says when he thinks you're full of it. You know what I'm talking about? And you know what? I went through how you go about doing that. And he and his wife, or he actually said, hey, thank you very much. Appreciate the time, and got up and left. I didn't think I'd ever see him again. But he called about 3 weeks later and he told me, he goes, Steve, when you said that, it was an aha moment for me. In fact, I got chills. In fact, I got scared. That's the reason why I left. I said, well, help me understand what you're thinking here. He says, well, look, I was there in 2000. In fact, I had more money then than I do have now. And I continue with the risk, thinking things are going to be okay. And I lost almost 70% of what I had. I saw friends who had retired a couple of years early that had millions of dollars, only to have 1 or 2 million because of what happened, because they didn't reduce their risk. And the reality is they didn't realize that they didn't want to go back to work. And a lot of them did. And you know what? Or they downsize, change their lifestyle. And he goes, and I don't want to do any of that. But my concern is I don't know how to protect things and create my income because I've been spending my world accumulating risk. And I said, hey, don't worry. You're like every person who's looking to retire. Okay. So all we really need to do is we need to create a prevention strategy where we retain what you have, grow it with a reasonable rate of return so you can live the life you want in retirement, but protect it. And we spent about 2 months educating him. We brought in real estate experts, money managers. I educated him on safe products and things like that. And in July, we got everything set in place. And you know what? November hit, I get this phone call. He goes, Steve, my IPO is worth $25 million. He was all excited. You know what? In February, as you know, the world fell in. And the valuation of that stock went to next to nothing. I was supposed to meet him at the end of April. I met him at the end of April, but the stock was worthless. He got a notice that he's going to get 2 months worth of salary, and that was going to be about it. They still plan to retire because of the plan that we put in place. Now, his valuation, his portfolio went up to about $2.8 million before everything went to hits. But you know what? It only lost a couple $100,000. So he still had about 2.6 million. Now, for him, that still was able to enable them to create the income they need in retirement. In fact, the very first word he said, he just says, you know what? I'm very grateful. And I said, why? He goes, you either have a crystal ball or what? I said, no, I don't have a crystal ball. If I did, it wouldn't be here. Neither would you. But here's the thing that we did. All we did is some good planning. We recognized that there is a life transition here. And that life transition went from I'm working to I'm no longer working. And all we really did is we made it real simple. And I'll make it real simple for you. Think of your investments as red, blue, green. Okay. Red is Wall Street, stocks, bonds, mutual funds. Anything that has risk, stocks, bonds, ETFs, they're going to go up and down with the market, 30% up, 30% down. It's just the way it goes. If you're looking at the blue, you're looking at investments that are not correlated to the stock market. So if the stock market drives, guess what? This has a little bit, but not a lot of loss. And it has a predictable income, which people like. Okay. It adds stability to your portfolio. And then you have the green section, which is protected items like from banks and insurance companies that they have protection. Now, when you're looking at banks, you're looking at CDs and things like that don't earn much, but you always use equity linked CDs. Okay. You definitely want to talk to your financial advisor about that if you're interested in those things. And then you have annuities. You know what? You have fixed annuities and you have fixed index annuities. Okay. So for example, with a fixed annuity, it's a lot like a CD, you get a guaranteed interest rate. But we have a fixed index annuity, it grows with the index as opposed to a fixed interest rate. So if you have a 10% upside, you could get a 7% increase and it locks in that growth. So if you started with 100, you have 107. And if the next year the market crashes, you still have $107,000, which is wonderful. Now, the key here is you take a look at this. You say, hey, how much do I want in the red section, the risk section? Hey, I want 30%. I want 40% in the predictable income section. And I want 30% in the guaranteed section. It's all going to get it's all going to combine to generate a certain rate of return so you can live the life you want. But let's take a look at it when it hits the market. So for example, if you have $1 million there and the market goes down by 30%, you're only dropping by 30% of 30, which is a 10% drop over the whole piece. And if you look at the critical income and say you're getting 7% there, hey, I lost 10, but I gained 2. So I have a net loss of about 8. Wow, 8% is a lot easier to recover from because I only need about 9% to recover as opposed to 30, where I'm going to need 50% recovering. A lot of people out there are listening, and what they're listening to is they're saying, hey, you know what? I'm still working because the impact of 2008. So the key here is this. Everybody looks at risk differently. Some people love the reward they get from taking on risk, while others are proactively taking steps and putting measures in place. So if things don't go as planned, they don't take as big as a hit. Okay. So the key here is this. if you're a couple of years to 5 years away from retirement, it's important to look at ways to reduce and eliminate risk. Because quite frankly, there's a lot of advisors out there that say, hey, don't worry, it's only a paper loss. It's only a loss if you sell. Well, the issue comes with this. If you're in the first couple of years before, a couple of years after retiring, 5 years before retiring, and you take that significant hit, you might not have enough time for your portfolio to grow before you have to start taking income from it. So it really doesn't give you that opportunity to grow so you can access your savings in that short period of time. So think of those things. You know what? A lot of people don't understand real estate, and that's the reason why they have everything correlated to the market. You know what? There's ways you can invest in real estate. You can do it through a rental property. Okay. You can do it through a real estate investment trust. You can do it through a Delaware statutory trust. You can also do it through a TIC. The key here is you want to find a specialist who understands those that can educate you. So again, the message here is this. You want to make sure that you have some sort of diversification with your portfolio. You want to make sure you're reducing and eliminate risk. You want to sit down with your advisor to go about doing that. Now, that's all for this segment. I hope it gave you some great advice to make a difference in your life. Now, you want to stick with us. We've got a great segment coming up with Danny Artach.